Okay, hey, welcome everyone to another Options Millionaire Podcast with your host, Peter. Now, today's episode, before we begin today's episode, I wanted to share an email I got from one of our students this morning. Now, I'm not going to share any particulars, but it doesn't matter. I just kind of wanted to go through this because I think it's important. And I wanted folks to understand when it comes to any type of financial investing or trading course, there's some things you should pay attention to. So, in this email, my students shared their experience with a pretty well-known influencer who's marketing an options trading course. Nothing wrong with that. Now, in all transparency, I'm not knocking educators for their marketing of products or anything like that. It's just I wanted to point out something that um, Travis taught me. He never did this, and he taught me never to do this, and I just don't do it. So, and this is basically to build into our marketing unrealistic expectations. It's something that I just don't think is right. And you really need to go into everything that someone's marketing with that in mind. Okay. Um, so, um, Basically what this was a 90-minute free webinar, right? And I've done free webinars in the past, and actually I am going to start doing them again in the future. They're going to be free webinars, but make no mistake, they are designed to get you involved with the Options Wealth Academy. All right. So whether it's starting out with our free course or you go to a paid version, that's basically what a webinar is designed to do, a free webinar, right? But in this webinar, they basically told everyone that they can learn how to trade options in just 2 days. Now, in all honesty, to be all to be perfectly honest with you guys, I could teach you how to trade options in 2 days. I could teach you right on this show how to trade options in 2 days. Um, You'd be completely and thoroughly confused after those 2 days, and you really wouldn't know anything other than how to place an order or how to sell an option, how to sell a two-legged option like a vertical credit spread. I could probably teach you that in 2 days. And from what it sounds like, the course is pretty in-depth. It's a live 2-day session. So it's probably all day long, like 8 hours. And they're going to jam pack as much information in it as they can. Um, but uh, like I said, to tell you I could teach you how to trade options in 2 days, sure, I could do that. Realistically, I couldn't teach you how to trade options successfully in 2 days. I couldn't even teach you in 2 weeks, 6 weeks, 6 months. I try to, some people's learning curves are different, but um, to suggest 2 days is an unrealistic expectation. You're not going to learn options trading to be a successful options trader in 2 days. It just doesn't work that way. One last thing I did want to share from the student's email, though. He says, I don't think this is an example of the worst, and maybe there's some value there, but I think it demonstrates what a great value OWA is and how the strategies you teach are learnable for most people and take more than 2 days, laugh out loud, while avoiding get rich quick type content. One of the things that drew me to the OWA was a podcast episode where you talked about the guru who claimed he turned $500 into 1 million in 51 days. And that guy has millions of followers. Now, just to kind of go back to that episode, the reason I brought it up is because it is statistically impossible to do. You can't do it. I've already run all the numbers. There's no way you can do that. So for someone to make that claim, I'm sorry, but you've blown the trust I might have with you. I don't know you, so I don't really trust you, but you've blown any chance of me getting to know you and trusting you when you make a claim like that. So here's a quick lesson here. It's a saying that Travis's wife came up with. I know he asked me, he's like, hey, how did you know that? And I think he mentioned it one time either in one of our podcasts or maybe in the Success Academy, but it's basically expectations minus reality equals disappointment. And I want you to think of something. Think of how long you've been working in your career and tell me if there was a new hire that the company just hired, do you think they'd be just as capable as you in a week, a month, or even a year? I think we all know the answer to that question. And so do the people that most often run these companies. I'd be willing to bet that if I took this influencer's course on options trading and then asked to be one of their traders or trainers to be paid and work in his company just after 1 week or even 1 month of doing their options trading course, or to use their tagline, 2 days, I'm pretty sure they'd ignore or even laugh at me, right? And I'm sure, as most of you listening, trading options isn't a short term process for those that are truly serious about success. If you're really serious about learning how to invest or trade options or even stocks, if you're really serious about it and you want to do this maybe as something that replaces your full time job, add some extra income, whatever the case is, if you're looking for the 2 month or 2 day course or 6 month course, I don't think you're going to be successful with it. And I would give some kind of free advice to folks that are looking for that. It's a lot easier and cheaper to just play the lottery, right? A lottery ticket costs a few bucks. Be a lot easier. You don't have very good chances with the lottery. You don't have very good chances learning how to trade options and invest, in my humble opinion, in just 2 months or 6 months or even a year. Many of our students, they understand and they grasp the concepts within 6 to 12 months. But the truly successful and serious ones, they stick around for a long period of time. They get their accounts up to that six-figure mark to then go into OWA 2.0. Um, so having said all that, it kind of brings us to today's episode where we're going to cover confidence versus overconfidence in trading. And there's kind of a little tagline that I found here. The most dangerous moment in trading isn't after a loss, it's after a winning streak. And that's very powerful. So, what I want you to do, though, let's start off. I want you to imagine two traders, and both have made money for 4 straight months. Both have nearly identical account sizes, and both use similar strategies. Yet one continues growing steadily while the other gives back months of profits in just a few weeks. So, what do you think changed? It wasn't the market, it wasn't their strategy, it was their mindset, right? They're both doing the exact same thing, yet one of them gives back all their profits in just a few short weeks. And that's what we're going to talk about today. It's one of the least discussed, but probably one of the most dangerous psychological shifts in investing. And it's the difference between confidence and overconfidence. And they're not the same thing. In fact, one builds wealth and the other destroys it. So to start off, let's kind of take a look at what confidence really looks like. And when you think of it, many people will kind of believe that or think that confidence means believing you'll win. And the reality is, successful traders and investors know better. That's not what that means. Matter of fact, I go into every trade based on what Travis taught me, because this is what he did. I go into every trade expecting I'm going to lose money. Real confidence means believing you can execute your process regardless of the outcome. So you got to notice the difference there. Confidence isn't certainty, it's consistency. And in the Options Wealth Academy, we never promise every trade wins. We promise that if you consistently execute a proven process, the probabilities will work over time. Confidence sounds like something like this. I've seen this setup before, or the probabilities favor this trade. If it loses, it's part of the business. Confidence accepts uncertainty. So now let's kind of take a look at what overconfidence sounds like. So it's kind of subtle. It rarely announces itself. You don't typically know you're becoming overconfident, but you'll start to think this way. You'll start to say to yourself, "I figured this market out. This one can't lose. I'll double my size. I don't need to wait for confirmation. I'll make it back quickly." Did you notice something there? The whole process has disappeared. The trader begins relying on themselves instead of the system. And that's when mistakes begin. Oftentimes, the first rule to go by the wayside when overconfidence appears is risk. And that's really the dangerous aspect when it comes to trades actually when those trades actually work out. So, for example, you become overconfident, you start risking more, and the trades work out. That's more dangerous because it leads to continuing down this dangerous path. And before you know it, you get caught in a correction, and because you were doubling your sizes or maybe tripling your sizes, you take a hit and it wipes out everything. So let's look at the psychology behind overconfidence. So behavioral finance has studied this extensively, and researchers consistently find that investors routinely overestimate their knowledge, their forecasting ability, their skill, and their probability of success. And one of the most famous studies comes from the psychologists David Dunning and Justin Kruger. It's called the Dunning-Kruger effect. And it demonstrates that people with limited expertise often overestimate their abilities, while experienced experts tend to be more aware of uncertainty. And ironically, the more you truly understand markets, the more respect you have for risk, right? Professionals rarely believe they're smarter than the market. I know I don't. I can never predict the market, which is why I don't try. I don't, I often, you'll sometimes hear me say the market doesn't care what we think, because it doesn't. I'm not trying to predict it. I just focus on the process, and that's what gives me my edge. And for professionals, that's the same thing. They simply have a process, and that gives them the edge, not trying to figure out the market, right? Now, there's another one, another study. It's by Brad Barber and Terrence O'Dean, and it says confidence can become expensive. And they've studied investor behavior probably more than anyone. Across multiple studies involving tens of thousands of brokerage accounts, they found something remarkable. The investors who traded the most consistently earned lower returns than those who traded less. So, why do you think that is? Well, because mainly successful trades increased confidence. But eventually, that confidence became overconfidence. And it led to more trades, larger positions, higher transaction costs, more mistakes, and poorer returns. Winning made them worse investors. It's one of the greatest paradoxes in investing. It's incredible. So, how does overconfidence kind of show up? Well, it rarely begins with reckless gambling. Instead, it starts with small rule violations, right? So maybe you increase your position size from 2% to 5% because you've had a string of winning trades. Then you start to skip your checklist. Before you know it, you're entering before you get confirmation. And then you convince yourself this time it's different. Soon you're taking trades that don't meet your criteria, not because the strategy changed, but because you changed. And there's a thing called the winning streak trap. Most traders think losing streaks are dangerous, and they are if you're not paying attention to them. But winning streaks can be even more dangerous because winning creates dopamine, which and helps with optimism, reduced perception of risk, and illusion of control. And your brain starts believing the profits came entirely from your skill. You forget the role that probabilities played out here. And that's when traders begin abandoning risk management, like I said in the beginning. And ironically, the better they've been doing, the worse their decisions became or become. So now let me kind of shift gears here and just show you kind of what confidence looks like in OWA. We don't spell it out that way, but this is just how it is. Inside the academy, confidence doesn't come from prediction. It just comes from preparation, and it comes from discipline. So we know going into every trade, we know our maximum risk before entering, we know our profit target, our exit rules, what stage the market is in, and position size. Remember, risk parameters and position size are two things. I covered that in a previous episode. Bottom line here is nothing's left to emotion. That's why our members aren't trying to predict every move. They're just simply executing the template. It's not as easy as it sounds, but that's what their goal is. That's what our goal is, to teach them. Just execute the template, um, void of any emotions. And that's a completely different mindset. And the other part of this is discipline. And I can tell you from my own experience, as well as overseeing hundreds of students between the Options Wealth Academy and the Success Academy, discipline is one of the most difficult skill sets to master. Now, I'd be willing to bet There's students inside the Options Wealth Academy that may have abandoned the templates over the last few weeks because the market was falling or pulling back. June and July weren't really good months. The market didn't really go anywhere. And the reality is, market pullbacks are not abnormal, nor are they rare. They happen all the time, but they're also not predictable. I can't tell you when it's going to happen. I can only tell you when it's happening, right? But when you don't take the time to actually put in the work to improve each and every day, week, month, or year, you don't recognize these patterns that the market has. For example, summertime is typically a slower time for the market. And if you think about it, it stands to reason. In the United States, most people take vacation during the summer months because that's when school's out. Well, institutional investors and pros aren't any different than you or I. They take vacations during the summer months. So you often see some weird moves in the market. And when you really pay attention to the chart and start studying it, you notice that volume has dried up. So these moves are not being made by institutional investors. Um, so to the casual trader, they instinctively think, oh, we're headed for a bear market or a big correction or something bad is going to happen, and they'll stop trading. But to the seasoned pro or someone that's been doing it for a while, they simply follow their template, checking back in on the market each day until they get their trade signal. For the casual trader, they walk away, and by the time they come back, the market's moved up significantly. They then begin to revenge trade in an effort to make up for lost time. And ironically, it always seems as if this is when the market falls, almost as if the market were watching just their computer or just their trades. And I've heard this so many times from students and clients that as soon as they place a trade, the market falls. Do you think that's a coincidence, or does the market really just have it out for them? What do you think? Do you find yourself making the same claims when a trade goes against you? It's okay to feel this in the beginning when you're first starting your trading journey. But I got to tell you, if you've been doing it for several years now and you still feel this way, then you aren't trading based solely on a system. You're allowing your emotions to get tangled into your trade plan. And while this may seem normal and acceptable, it isn't. And it's going to cost you one way or another. It's either going to cost you in profits or it's going to cost you the worst way in losing capital. Now, you may not have a lot of losing trades, but after a while, what you'll notice is your profits begin to shrink and they can barely cover one losing trade in the span of a year. And this is mainly because folks will have this flaw in their skill set where they exit too early because they always think the market is against them when they place a trade. They're fearful that their profit is going to be lost, so they figure the best course of action is to get out early and forgo a losing trade. In reality, though, they are only foregoing the inevitable. And when that day comes, it tends to do a lot of damage. They have a lot of small winning trades, and just one long correction wipes out all those gains along with some of their capital. And unfortunately, for some folks, they end up quitting. And this is where discipline in your process eliminates this issue. Instead of going into each trade expecting to win, go into each trade to be able to perfect your process. Trust me, the profits are going to come, but not without a proven system executed with as little errors as possible. The goal isn't to be perfect here, it's to be disciplined and consistent. So let's look at some of the questions that may reveal overconfidence. These are 5 questions every trader I think should ask themselves. Number 1, am I increasing size because of my rules or because I've been winning? Number 2, would I still take this trade if my last 3 trades were losers? Number 3, am I following my checklist? That's a big one. Are you using a checklist? Number 4, am I trying to impress myself? Am I looking for bragging rights here? Number 5, am I trading based on my system or my opinions? And those 5 questions can prevent months of unnecessary losses. And to kind of start to wrap this up, Warren Buffett's perspective was this. He once said, risk comes from not knowing what you're doing. Many people interpret that as knowledge, but I think it goes a little bit deeper than that. Knowing what you're doing means knowing exactly how you'll behave before the trade even begins. Uh, Discipline removes that emotion, and confidence follows discipline, not the other way around. So here's some practical ways I think you can stay confident without becoming overconfident. And it's kind of what professionals do, and it's what has worked for me, and a lot of the students within the Options Wealth Academy. So first, use fixed position sizing. So never increase your size simply because you're winning, right? So what do I mean by that? So if you have a specific account size, like for us, we usually risk 2% of our account size on a trade. So but let's say I'm just starting out and I have $100,000 account. Do I really want to risk $2,000 or $4,000 on that trade? This is where position sizing can come into play. Maybe you don't want to risk that much. So you're like, you know what? While I'm learning, I'm just going to do 2 contracts. It's risking me about 400 or 500 bucks, and I'm good with that. Number two is keep using your checklist. Here's an important point. At any point, if you feel the checklist is unnecessary, that's when you need to use it the most. Okay. Number three, and this is a big one. We're starting to do this more with our students, and I'm doing it with my clients. Instead of reviewing their performance, I'm reviewing their trades. Review every trade, not just the winners. Review the execution, review the losers, and as well as the winners, right? Check out the execution for each trade and determine, hey, did I follow the checklist? Did I follow my system? Number four is celebrate following the process, not making money. Um, those aren't always the same thing, right? So you should set milestones that, hey, I'm going to execute X ways this week or this month, and I'm going to keep track of it, not whether you made money or not, right? And number five is respect uncertainty. Uncertainty. Every trade can lose. There are no exceptions. Okay. So, in closing, I want to just say the market has a remarkable way of humbling everyone. It's not immediately, but eventually. Confidence tells you I can handle whatever happens, but overconfidence says nothing bad will happen. Those are completely different beliefs. Once one keeps you disciplined, and the other removes discipline entirely. Just remember, markets don't reward certainty, they reward consistency. The trader who lasts the longest aren't the smartest ones. They aren't the boldest ones. They're the ones who continue following their process long after they become successful. And that's exactly what we teach inside the Options Wealth Academy. Discipline drives results. And one last thought. It's something I'm doing more with the Academy, especially in our marketing. And I think you should do it too, is to stop focusing on returns. I used to keep goals of what I wanted to generate for returns. And the reality is, you can't control those. The market determines what your return is going to be. The only thing you can control is your process. And it's interesting when I come across people and they learn what I do, their first question is nearly always, how much of a return do you get? And I got to tell you, it's the wrong question because no one can predict or even work toward that goal, in my opinion. The market determines how much you're going to make. It determines how much I will make. I determine how much I'll lose and how and when I will trade. And when you make your number one goal about returns, it becomes an effort really in futility when the market doesn't cooperate, right? Because eventually ends up happening is you start to violate your template because the market's not cooperating, but you have to hit that return, right? So one of the things I talk about this a lot, I only teach folks how to trade in bull markets because that's all I do. I don't trade in bear markets. So when the market corrects for 5 months, I don't have a strategy to show you how to make money. And this is typically when I see some students fall off. Their first indication is that the templates don't work. Ironically, the strategies I teach in the bull market has already prepared you for the bear market or correction. They just don't see it. Those that fail to recognize this typically quit and look for another strategy. Years go by, and one day they wake up and realize they've made zero progress. They just keep chasing after the next bright, shiny object. So, if I can provide you with just one takeaway from today's podcast, it's this: focus on perfecting your skill of trading. Perfect trading your trading skill set and let the profits take care of themselves. If you focus solely on generating a specific return, you'll have a hard time staying disciplined when the market goes against you. At that point, one of two things starts to happen. Traders either quit entirely looking for another program, or they begin violating the template, forcing trades with abandoned risk parameters. And by the time they realize what's happened, it's too late. They've wiped out their accounts. So if you enjoyed this episode, please subscribe to our channel and share it. And remember, leave us a comment. I do read them all and I respond to each one. So that's it, you guys. You take care. We'll see you next week. Bye-bye.